Good day to you all, and today, as a result of a request from one of the growing body of fans who are viewing the Monckton YouTube channel and Monckton's Monday Musings, we've had a request to talk about what sounds like a technical subject of fractional reserve banking. I'm going to call it funny money, because what we have is a coming crisis as the various fiat currencies of the world, these are currencies that don't have any assets anymore to back them up, gradually become ever more worthless. To give you an example, the US dollar was worth, say, 100 cents in 1913, about 100 years ago, when the Federal Reserve Bank was set up to preserve its value. But now, you find that $1 today is worth only 1 cent in 1913. The 99 cents of a 1913 dollar has disappeared from the present dollar. That's how bad the decline in these so-called fiat currencies has been over that 100-year period. It's much the same with the pound sterling, a bit less so with the mark or the Swiss franc. The French franc has had terrible trouble. Most of these promissory currencies, where the government tells you the currency is worth a certain amount, but it hasn't any longer got any gold in Fort Knox to back it up, these currencies are dangerous to hold. They make the whole financial system dishonest, and they're combined with a practice known as fractional reserve banking. I'm going to explain very briefly what that is. Fractional reserve banking is where banks who are licensed by the central bank in each country to do this are allowed to lend. The typical ratio is approximately 10 times the amount they've taken in deposits. So if you run a bank and you take $1,000 in deposits, you can lend 10,000 against the 1,000 you've borrowed. Now, in normal, stable times, that works out all right. But then what happens is the banks get greedy and they say, well, if we could lend even more against what we've had from our depositors, then we can make more money. And that's what happened during the 2008 financial crisis. Instead of maintaining a ratio of $10 of lending out for every $1 taken in, they began to lend out 20 or 30 for every $1 taken in. And of course, eventually, the system failed, and banks began going under and had to be bailed out by taxpayers. Now, I think they shouldn't have been bailed out by taxpayers. It's better to remind the banks that they're not too big to fail, and that if they are not willing to run a disciplined ship, they can't look on Johnny Taxpayer to bail them out. But how do we square this circle of fractional reserve banking and this funny money that governments print? And the answer is to have a new currency, which I'm thinking of setting up myself, because you can do this privately. And I originally had long talks about this with Friedrich August von Hayek, who was a great economist of the Austrian free market school, and Margaret Thatcher was a great admirer of his. When I worked for her, I met Friedrich August von Hayek, and I asked him about his idea for having competing private currencies which would operate alongside official national currencies and eventually drive them out. Because although there's a thing called Gresham's law in economics, which says that bad money tends to drive out good money, there is one exception to that. And that is if you have what's called a fully funded currency. And that's a currency which has assets fully backing up the pieces of paper that are in issue. Then that good money will drive out the bad money, because everybody will want to do their transactions in a currency that isn't going to change its value through inflation and messing around every year. And there was a very good example of this in Hamburg, where for 250 years, until about 1798, when Napoleon invaded, the Bank of Hamburg had issued a thing called the Mark Banco. This was a unit of account. It was effectively a currency. And that was the unit of account in which businesses all the way from northwestern Europe, that's Hamburg, all the way down to southeastern Europe in Venice, They all denominated all their international transactions in marked banco. Why did they do this? Because the value didn't change at all in 250 years. None of this business of, like the dollar, losing 99 cents of its value over 250 years. It kept its value exactly all the way through that 250-year period. How did they do that? They made sure that for every piece of paper they issued, there was the equivalent amount of silver, that was the numeraire that they used, in the vaults of the bank. So that even if everybody turned up at the same time and said, right, we want to cash in our notes, there was enough silver to pay everybody out. And they usually ran a 3% surplus, so it was what's known as 3% overfunding. And that meant that this was completely honest money. And the effect on Europe of having completely honest money was that they went through a period of terrific prosperity and growth, which is really unparalleled in economic history anywhere. And it's all thanks to one bank deciding it was going to run some honest money. Now, at the moment, nobody in the world does this. And that's extraordinary, because I've done some initial calculations, and I reckon it's actually more profitable to issue a currency that doesn't inflate than to issue a currency that does inflate. And the reason for that is that once we are in business, everybody will want to keep their loose cash in an account denominated in, let's call it, the talent. And they will say, well, we'd rather keep, we have the odd few $1,000s in our bank account so we can pay our bills and take money in and so forth. And instead of having that wasting away every year with inflation, if you have that denominated in talents, then you're going to be more or less, as much as we can guarantee, proofed against inflation, because as soon as you give us your pounds or dollars or euros or other Mickey Mouse currencies, we spend those that day on buying real assets that represent the value of the currency you've given us and that we've then issued you an electronic token for. And you can use the talent with your credit card to do your purchases. We won't be printing or minting notes. Those days are gone, that the world's moved on from that. But you will be able to use your credit card linked directly to a talent bank account, and you will know that the money in that account will not be wasting away through inflation as everybody else's money will be. And we think that once we do this, we will have solved the problem that Bitcoin was set up to address but failed to address, because Bitcoin tries to do the same thing but by using what's called a scarcity algorithm. And the problem with that is that it doesn't actually work. So that if you put your money into Bitcoin last year, you'd have lost 78% of its value. And obviously that kind of instability is even worse than a fiat currency. So what we're proposing is to have a proper, fully funded currency where the moment you give us your pounds and dollars, we give you a proper promissory note in the form of an electronic token that you can spend on your credit card account, but we then buy, with the money you give us, real assets that are then managed by professional fund managers. So there'll be two arms to this. One will be the banking arm that deals with you. The other will be the fund management arm, which will both be professionally run. And the idea is that this would be regulated, possibly in London, which is strict but reasonably sensible. Now that we're leaving the EU, we no longer have to fear the obsessively overdone regime of regulation that the EU was beginning to inflict on the city. So it will be regulated, but this will be a properly managed currency, rather like the Bank of Hamburg. And this time we would have not just silver, we'd have a basket of not only commodities, but also blue chip stocks, real estate, broadly spread, both sectorally and geographically, so that if one part of the market goes down, another part goes up. For instance, if the stock markets worldwide take a crash, what happens? Up goes gold and silver. If you've got a position in both, you can more or less level things out. And any good fund manager knows how to do this. And so by this means, we can make sure, as far as is humanly possible, that at last, honest money is reintroduced to the heart of the financial system. And we would expect quite rapidly that good money would drive out bad. And people would simply stop using these Mickey Mouse currencies like the pound and the dollar and the Australian dollar. And they'd say, right, we've had enough of that. We want real value for our money now, and the way to get that is by doing away with funny money, doing away with these things. And then, if you have sound money, fractional reserve banking becomes less of a problem than it is if you have duff money. Fractional reserve banking is not in itself wrong, as long as you make sure that the reserve ratio is a sensible 1 to 10. And if you let it go beyond that, that's where you get into trouble. So inherently, there's nothing wrong with fractional reserve banking, but if the banks are tempted to break the rules and try and make a fast buck, as they did in 2008, that's when things go wrong. And so to stop that happening in future, you say to the banks, if you do that again, we won't bail you out. And that will drive the bank's customers into our arms, because they will know that what they really need is safe money, where we're not going to be lending against the asset fund. So there you are, the talent, a solid currency, or rather it's beyond currency. We won't be allowed to call it a currency, though it will serve all the purposes of a currency except one: it won't inflate. So that's our idea. If you like it, send us a comment. And once again, thank you for watching, and God bless you.